Maria is watching Eurodollar climb 10 minutes before a big U.S. jobs number. She wants in. She hits buy at market, confident the fill will be close to what she sees on screen. 3 seconds later, her platform shows the trade open, 22 pips worse than the price she clicked. Not a glitch, not her broker robbing her. This is exactly what a market order promises, and exactly what it does not promise. A market order is built for one thing only: get me in right now. It does not care what price you get, only that you get filled immediately. In calm markets, that gap is nothing. Around news, when price is jumping, that gap can eat a week of gains in one click. Maria did not lose money because she picked the wrong direction. She lost money because she picked the wrong order for the moment. That is where we start. So what should Maria have used? A limit order. With a limit order, she names her price, say the exact level she saw before the spike, and the order simply will not feel worse than that. The trade-off: if price never comes back to her number, she never gets in at all. That is the whole deal with a limit order. Price control. Execution not guaranteed. A market order is the mirror image. Execution guaranteed. Price not controlled. A market order makes sense when being in the trade matters more than the exact price. A fast breakout you cannot afford to miss. A limit order makes sense when you have a specific level in mind and you are willing to walk away if price never comes to you. Maria's mistake was not the tool. It was reaching for speed when she needed control. Say Maria gets her limit fill, and she is now long Eurodollar. New problem: what stops this trade from turning into an open-ended loss? Pause the video right now, look at this candle chart, and find the level below the recent swing low where you would place a stop if you were long from here. Got a spot? Here is the idea. A stop order sits silent below price, and the moment price trades down to that trigger, it converts into a market order and closes you out. This is your stop loss. Entry trigger was the limit fill. Stop placement goes a few pips below the last swing low, not right on it, because price often wicks through a level before reversing, so you give it room to breathe. Target gets set using a reward at least equal to what you are risking, ideally more. Write this down. The setup can be completely right and still fail. The stop is not a backup plan. It is the plan for when you are wrong. Here's something that surprises most new traders. A stop order does not actually guarantee your exit price. It guarantees a trigger, then it becomes a market order, and in a fast enough drop, it can fill well below where you wanted. The fix sounds perfect on paper. A stop limit order adds a second number. Once your trigger hits, it does not just sell at market. It places a limit order at your chosen price or better. Sounds like the best of both. Here's the catch nobody warns you about. If price blows straight through your limit price without pausing, your order never fills at all, and you are still in the trade uncovered, while price keeps falling. Stop limit orders guarantee price. They do not guarantee you get out. Now flip the problem around. Say Maria's trade works and price runs well past her target. A fixed stop just sits there while profit builds, then gives some back on any pullback. A trailing stop fixes that by moving. You set a distance. Say it trails 20 pips behind price. As price climbs, the stop climbs with it. If price ever turns and falls back that 20 pip distance, you're out, profit locked. Quick check before I show you the math. If price moves 50 pips in Maria's favor and her trailing distance is 20 pips, how many pips is she guaranteed to keep at minimum? Pause and work it out. 30 pips locked, because the stop only ever moves up, never back down, and the part that actually saves your account over the long run is still coming. All the orders so far assume you're watching the screen. What if Maria wants to plant an order today for a level she expects price to reach next week? That's a good till canceled order, GTC. It just sits in the market, active, until it fills or she cancels it herself. No re-entering it every morning, no staring at charts all day, which makes it built for traders thinking in days and weeks, not minutes. It carries the same price control as a limit order. Name your level, wait for it. But there's a real cost. If price never reaches that level, the order just sits there doing nothing, unless you check it. And here's the trap. Sometimes price races toward your level, almost touches it, and reverses before filling. You watch the trade you wanted happen without you in it. GTC still needs a periodic look. Not daily babysitting, but not total neglect either. Here's the piece that ties all of this together. Maria is finally in her trade, with a stop protecting the downside and a target in mind for the upside. Right now she'd need two separate orders, and if one fills, she'd have to remember to cancel the other by hand. An OCO order, one cancels the other, links them. Set a take-profit limit above price and a stop below it at the same time. The instant either one triggers, the other cancels itself automatically. No manual cleanup, no emotional second-guessing about holding for more or bailing early, because the decision was made back when Maria was calm. This is the thing this whole video was building to: an entry with control, a stop that protects it, and an exit that runs itself. One real catch: not every broker offers OCO, so check first, and you still need to understand exactly how your broker's version behaves, because a setup mistake here executes automatically too. Let's put Maria's whole trade back together. She should have used a limit order to control her entry instead of a market order. Once filled, a stop order protected her downside, with room below the swing low instead of sitting right on it. A trailing stop would have let her ride a bigger move without giving profit back. If she'd wanted to plan this days ahead, the GTC order keeps that limit order live without her watching. And wrapping the exit, an OCO order sets her target and her stop together, so one fills and the other cancels itself automatically. Here's the rule worth writing down. New traders trust their nerves to exit a trade. Traders who last trust their orders to do it for them. Go set a demo OCO order this week before you ever risk it live, and tell me in the comments which pair you're practicing this on. Next time, we get into exactly how much size to put behind every one of these orders, because the right order with the wrong size still wipes you out.